7.45%.
Okay, well, Ed Yardeni is now joining us. He's president at Yardeni Research. Ed, good to have you with us here. Thank you very much for your time. So the new thing this morning is the big jump we're seeing in oil prices, which affects everyone around the world. How big an inflationary impulse is this likely to prove for policymakers, in your opinion?
Well, I think initially we're all just going to have to sit back and see how the market settles out. I mean, clearly it was a big surprise, and there were some shorts that had to cover. But I think it's possible that one of the reasons the Saudis have announced a cut is because they recognize that the global economy may not be as strong as widely anticipated. The Chinese economy has picked up since the end of its lockdowns, but it hasn't been a real gangbusters boom over in China. And meanwhile, the U.S. has this banking crisis, which is bound to slow economic growth. I don't think it's going to cause a recession. But I think in many ways, the Saudis took a preemptive, preventative approach here, fearing that the price of oil would continue to decline.
Ed, hi, good morning, and thanks for being with us on the channel. How do you see the equity markets globally evolve from here? One narrative is that the worst of the crisis, the recession, the rate hikes have already been priced into global markets, including markets like India. Would you concur with that view?
Well, I think that once again, the Federal Reserve is turning out to be the key player here that affects everybody else playing the game. The Fed is likely to perhaps go up by another quarter point. I think they should be done, actually, because I think we are continuing to see inflation moderate. And meanwhile, the inverted yield curve has been predicting since last summer that if the Fed continues to tighten, something might break in the financial system. And sure enough, we have a banking crisis. I don't think it's anywhere near the banking crisis we had in 2008. But nonetheless, it is a crisis, and banks are going to slow their lending. The economy is going to slow. And I think inflation is going to continue to moderate. So I think the global economy, focusing on the Fed, probably recognizes all that. And I should say the global financial markets recognize all that. And as you mentioned before, the lower interest rates are very beneficial to technology stocks as long as it doesn't signal that we're going to fall into recession. I'm in the soft landing camp. I'm in the camp that argues that we've been in a rolling recession rather than an economy-wide recession.
Hi, Mr. Yardeni. Good morning. We've been talking about QT and a lot of worries out there, but a first sniff of trouble with regard to these banks. And the Fed's balance sheet is indicating QE yet again, the updated number that they've put out. Do you expect more of the same, or do you think that it's temporary?
Well, it's all pretty confusing, right? Here, they're still got QT going on. They're still letting maturing securities off their balance sheet. They're not buying new ones. But at the same time, their provision of liquidity to the banking system has been quite substantial just in the past 2 weeks. And that means that their total assets have actually increased, even though they're still committed to QT. So we've got this very strange combination of QE on the liquidity bank crisis side and QT on the long-term effects of trying to manage some backing away from all the excessive QEs of the past few years. I think on balance, we have to just focus on what the outlook is for the federal funds rate. And I think what the market has come to realize is that we're at restrictive. We're probably very close to terminal, if not actually there. And that's why we've seen bond yields come down and the 2-year yield come down. And that's beneficial for the stock market.
The other big problem that the U.S. economy is facing is layoffs, right? I mean, I was just looking at the data. In the first quarter of this calendar year, 136,000 people have been laid off. That has already exceeded the layoffs in the last 6 months of 2022. And the fear is that with these layoffs, employees losing their jobs, higher inflation could pinch further, a multiple round of rate hikes could throw the economy further into recession. Have you priced that into your argument about how weak the markets could get, or is that an additional fear that could perhaps, derail the markets further?
You make a good point, because we always get very low unemployment rates right before bear markets in stocks. Well, we've already had a bear market last year. I think it ended on October 12th. We could have another downdraft in the market if there's a perception that we're losing the consumer because consumers are losing jobs. The labor market is another example of all the confusion that has occurred as a result of the. And I think in this case, what we have a lot of layoffs, particularly in technology companies that hired too many people, and now they're cutting back. But a lot of those people are very skilled, very educated, and are probably going to be finding a job isn't that hard. By the way, a lot of them also got severance pay, which is maybe why we haven't seen initial unemployment claims going up. But the other thing that's going on is people like myself, baby boomers, a lot of my friends are retiring. And you know what they do in their retirement? They spend money. They go to restaurants. And so the demand for employees in restaurants has been soaring. And they go to the hospitals just to make sure they're okay. And as a result of that, there's a tremendous demand for healthcare workers and restaurant workers.
Ed, we leave it there. Thank you very much. Great speaking with you, and catch up with you soon again. Thanks indeed. Ed Yardeni at Yardeni Research with a quick thought. Basically, I mean, we need to wait and watch for the oil markets to settle. How it's not 5% is a meaningful bounce, but will it go any further? And how long will it stay this high for? Are the two questions which I think markets will watch closely. We'll take a quick break here. Our list of top stocks to watch with our research team coming up in just a bit from now.